Welcome back, Navigators. In today's video, we'll understand the psychological traps that often lead to poor investment decisions like panic selling or FOMO-driven buying and how to overcome them. Investing can feel like navigating a financial roller coaster. We all want high returns, but the journey can be bumpy. It's easy to get caught up in the excitement of a bull market or panic during a downturn. But here's the thing, our emotions can be our worst enemy when it comes to investing. We're wired to respond to immediate threats and rewards. Our brains haven't quite caught up with the complexities of the modern financial market. This disconnect often leads us to make impulsive decisions based on fear or greed rather than logic and long-term goals. So, the most common mistakes investors do are the following. Anchoring bias, when we often rely too heavily on the first piece of information we see, such as a stock's historical price, when making decisions. To overcome this, regularly evaluate each investment based on its current fundamentals and potential rather than past performance. Then comes loss aversion. People feel the pain of losses more intensely than the pleasure of gains, leading to risk-averse behavior. This can cause investors to hold on to losing stocks too long, hoping to break even. To overcome it, set predefined stop-loss levels and avoid holding on to a losing position based solely on an emotional attachment. Then we have overconfidence. Many investors overestimate their ability to predict markets or stock outcomes, often leading to excessive trading and poor returns. To overcome this, regularly review your portfolio performance, consider a long-term perspective, and avoid trading based solely on intuition. Finally, there is the recency bias occurring when investors give undue weight to recent events, leading them to assume trends will continue. To overcome this pitfall, just broaden your analysis period and be wary of trends that might be short-lived or the result of temporary market reactions. Remember, investing, it's about making your money work for you over the long haul. That requires a calm, rational approach, not knee-jerk reactions to every market fluctuation. Further, we're going to explore two of the most important psychological traps that trip up even seasoned investors: panic selling and FOMO-driven buying. More importantly, we'll equip you with the tools and strategies to avoid these pitfalls and make smarter decisions for your financial future. Fear is a powerful emotion. In threatening situations, it keeps us safe. However, in investing, fear can lead to costly mistakes. When the market takes a dip and our investments lose value, it's natural to feel anxious. This fear can drive us to sell our holdings at a loss, hoping to cut our losses and avoid further pain. This behavior is called panic selling, and it rarely ends well. Selling when prices are low locks in losses and puts us in a weaker position to benefit from the inevitable market rebound. Think of it like this: you wouldn't sell your house for half its value just because your neighbor told you the housing market is crashing. Similarly, don't let short-term market fluctuations dictate your long-term investment strategy. On the flip side of fear, we have greed and its close cousin FOMO, fear of missing out. When a particular stock or asset class is skyrocketing, it's easy to get swept up in the excitement. Everyone seems to be making money, and we don't want to be left behind. This fear of missing out can lead us to make impulsive decisions, buying assets at inflated prices without proper research or understanding the underlying risks. We jump on the bandwagon hoping to strike it rich quickly. However, what goes up must eventually come down. Hype-driven investments are often speculative bubbles that burst, leaving investors with significant losses. Remember, chasing hot stocks is like trying to catch a falling knife. It's usually best to stay out of the way. The consequences of letting our emotions dictate our investment decisions can be severe. Panic selling locks in losses, preventing us from participating in future market recoveries. FOMO-driven buying often leads to buying high and selling low, the exact opposite of what successful investors do. These emotional decisions can derail our long-term financial goals, whether it's saving for retirement, buying a home, or securing our children's education. The money we lose through poor investment choices is money that could have been growing steadily over time, working towards our goals. Short-term market fluctuations are inevitable, but they shouldn't derail us from our long-term strategy. So how do we avoid these emotional pitfalls and make smarter investment decisions? The key is to build a sound investment strategy based on our financial goals, risk tolerance, and time horizon. Start by defining your financial goals. What are you saving for? When will you need the money? Once you have a clear picture of your objectives, you can determine your risk tolerance. How much volatility are you comfortable with? Remember, higher potential returns usually come with higher risk. Next, consider your time horizon. If you're investing for a long-term goal, like retirement, you have more time to recover from market downturns. This means you can afford to take on more risk. This means that stocks, ETFs, and even crypto would have a major stake in your portfolio. However, if you need the money in the short term, you'll need a more conservative approach. Thus, bonds and bank deposits would have a higher percentage in your portfolio. Have a checklist or investment criteria before buying any stock, including fundamental metrics, technical indicators, and your risk tolerance. Limit individual positions to a small percentage of your total portfolio and avoid putting all eggs in one basket. Investing doesn't have to be scary or complicated. By understanding how our emotions can influence our decisions, we can take steps to avoid common pitfalls. Building a sound investment strategy based on our financial goals, risk tolerance, and time horizon provides a roadmap for success. Books and courses on behavioral finance, such as Thinking Fast and Slow by Daniel Kahneman, help investors understand and combat biases. So it is a good practice to make reading about investor psychology part of your financial education. Incorporating lessons into your routine, there will be ups and downs along the way. But by staying calm, sticking to our plan, and making rational decisions, we can achieve our financial goals and secure our financial future. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.